Welcome back to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. Online, zinniawealth.com. Pretty easy. ZINNIA wealth.com. If it's time to talk about your retirement, it's time for you to take a step forward. Let's actually get a date on a calendar and really actually talk about it. Don't just talk about it with your friends. Talk about somebody who could help you with all of this. Let's do the math on your retirement. ZinniaWealth.com or 833-368-3680. As interest rates were going up, we told you about billions of dollars that were going into CDs and money markets. That totally makes sense.
Right.
As baby boomers continue to retire, they're looking for income. So we've told you about record numbers of annuities that has been sold, and that makes total sense. Well, today there's an article in the Wall Street Journal, and it says there are billions of dollars that are pouring into dividend-paying stocks. I can't come up with an answer why that, other than income. I can't come up with an answer for that, so I thought I'd throw it at you. Are you using dividend-paying stocks? Why do you see that there's an uptick in this?
Yeah, so that's one of our portfolio legs. That's just one of them. And there's an uptick in dividend stocks because when interest rates go down and you can only make 3.5% or even a lower amount, because when interest rates go down, those CDs are going to go down. You're going to be like, okay, I'm not making any money here. I need something that's going to make me more. A lot of people want to go to dividend stocks because if you get the hardy dividend stocks, you know, the Duke Electrics, the Abbeys, pharmaceutical company, you know, they pay, you know, on the higher end of 3% to mid 4% dividends every year. And remember, it's never guaranteed, but they're rather consistent, those types of companies, and people can see the growth in the company. It's a slower growth because they're giving you a match, basically is what I call it. They're giving you that free money, that dividend, and you can live on it and get that paycheck because a lot of people have these CDs in money markets and they're taking their returns or earning in them. They're using it as income. And so when the income isn't there, then people start to bob and weave and say, okay, I feel better about the stock market. So even in a dividend stock, one of the staples of the world, we're going to see growth over time, most likely, and we're going to get an income and we can live off of it. And so here's the deal in a dividend stock. Let's say you buy Duke Electric, and Duke Electric, I'm just giving you simple math, is at $50 a share and it pays a 4% dividend. Well, what if Duke Electric goes down from $50 to $40? Because that could happen, no problem. And it still pays, on average, close to that 4% dividend. So it's still paying you. You don't have to sell the stock, especially when it goes down, to get that income. You're going to continue to get that income. But remember, I have to say this compliance-wise, dividend stocks can change, meaning that 4% could go to 3.75. It can also go from 4% to 4.5. So it fluctuates. So you got to have this fluctuation and knowing, you know, where do you pull from if you do need that extra income in case you don't get that dividend that year or it goes down. And so people like that and they know that they can invest in the market and they feel comfortable about the market. But when, let's say you're not living on that income yet, and that stock goes down from $50 to $40 and they pay out that dividend, it's going to buy that stock at $40 a share. So you're getting more shares that's about to pay you another 4% dividend, right? And think of that dividend as like your 401k. You contributed money and they gave you a match, and that match was free to you. You just contributed to a certain amount and they give that to you. Same thing with the stock. You put money in the stock. Now you have a share. Now they're going to pay you a dividend, and that dividend is going to buy another stock, you know, depending on the price and what it's paying, of course. So it's just a nice little thing to sprinkle in as one of the legs of your income streams, potentially, when it comes to your overall portfolio. And yeah, I think every single one of our clients have that dividend strategy. And if you have $1 million portfolio, you might only have 100,000 in there. Maybe you have 200,000 because we have other strategies built in to do other things at different times of market cycles.
But as you've mentioned, dividends can vary. You may find something that has 3%, and then you may find something else that has 7, 8, 9, 10%. Is there a red flag when you see a company that has a dividend of 7, 8, 9, 10%? Because that seems pretty big.
Yes. So anything that's over, they say anything over 4.5% dividend payout is a riskier stock. So it's crazy because I just had a conversation and a longtime client of mine's like, Sharice, I really want this JP Morgan income fund. And I was like, okay, let's walk through it. I was like, let's go back to the last 5 years of this fund because it yields that dividend of 8%. And I'm like, just know that the higher the yield, typically it can be riskier. And I said, let's go back 5 years and it was at $68 a share. And a year later, it was down to $54 a share, and the dividend changed. Then the next year it went back up to 58 and reached back to 60. And the next year it came back down. So it's bouncy, and it's sideways over the last 5 years, but it paid a dividend each year, different dividends. It wasn't always 8%, right? And so if you're living off that income and you don't care about the value of your account, then it's fair game. If you're not living off the dividend and it's bouncy, sometimes that's okay too. So it depends what you're looking for, because it's just going to buy more of that stock. And so there's a value there. And as long as you don't care about the bouncing around of the account value, then why not?
So I've heard the term aristocrat dividend, or aristocrat companies and that kind of thing. So those are those almost like a blue chip stock, the long time kind of thing. Am I off base by saying that if somebody's offering 7, 8, 9, 10% on a dividend, they might be a young company that is looking to have people invest so that they have more money so that they can build their company, and that's the state that they're in, and the ones that have 2 and 3 and 4% might be the longer lasting companies that are more established?
That's exactly the case.
Okay.
That is exactly the case. So younger companies are trying to raise capital. They're trying to get new investors to keep building and building and building. So they're going to pay you more. But what happens is sometimes companies don't prevail. Sometimes they shut the door. So then what happens? Sometimes they're just having hard times and they're trying to make the stockholders happy, but they can't. And the stockholders start getting out. Now they're hemorrhaging. So there's a lot of those ups and downs that you don't know about that's internal, that's causing the fluctuation of dividends and maybe causing a company to go out of business. You want to be careful. The higher the dividend, the more risk. Bottom line.
Thanks for listening to the Retirement Coffee Talk podcast. If you have questions or would like to begin the process of building a tailored retirement plan, call Zinnia Wealth at 833-368-3680 or find us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.